Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
Oh, I'm doing awesome. How are you doing this morning?
I am doing awesome as well. It's always a pleasure to see you, and I always look forward to the topics that we're going to discuss, obviously surrounding the importance of planning for a proper, comfortable retirement, if you will.
Absolutely. No, it's been a busy time, and I'll tell you, there's a lot of important things to get to. So hopefully today's show will inform everybody about some things they need to think about here.
Most definitely, because Stewart, as we are entering into obviously 2021, the new year, if you will, there's going to be obviously the administration change. Let's talk about that first off. Do a lot of clients have questions about how that's going to impact them personally?
Absolutely. I think one of the big things that people are concerned about right now is obviously changes in the air. And you have to realize that, over the last several years, we've had one of the most efficient tax windows in history. And, let's put all the politics aside now. Hopefully, we're getting to an end of all of that. But the reality is that the Trump tax cuts really did benefit people all the way down to the 12% tax bracket. The 10% was basically left unchanged. The 12% was 15. The 22% was 25. The 24 was 28%. So everybody in those lower brackets really did benefit from it. So depending on what channel you watch for news will really determine how you perceive those tax cuts. But what we do know for a fact, however you decide to classify that, is the fact that right now we are in a very, very, very efficient tax window. And if change is coming, right now, there's a few things that we do know. People are saying, well, if the taxes increase, which we believe they are, just remember, there's literally a $3 trillion injection, now a $4 trillion injection of money into the system, right? So someone's going to have to pay for all of this stimulus. Well, everybody knows that it's going to be, you, the viewer, that's going to end up paying for all of this here. And are taxes going up? Probably. And so I think it's really essential to start planning around what we know now for a fact. Now, listen, I've been wrong before when it comes to taxes and Social Security. When we used to do these big, amazing workshops to talk about Social Security, and I always used to tell people that, hey, there's no way they're going to touch your Social Security. You're the biggest voting block. Seniors are this big voting block, right? But the reality is that in 2015, we lost tons of benefit for Social Security recipients in terms of their ability to file a restricted application or file and suspend, a couple different options. So I think it's really important to have a plan when it comes to that. And there are some pretty specific changes that have occurred here to the, or that we believe are going to occur to the tax system moving forward.
Absolutely. Stewart, let's talk a little bit about, we talked in the past about Roth conversions being beneficial for some of your clients. Can we dive into that a little bit further today?
Sure. Roth conversion and Roth contributions are things that I think people are conflating. They're kind of mixing up a bit. So let me try to break it down for you. First of all, a Roth, you have to understand what a Roth does. What a Roth does is, let's say you make $20,000, $50,000 at work a year. And when you contribute, for example, into your 401k, you get a tax deduction for contributing to that plan. So if you contribute, hypothetically, $10,000 for easy math, you're going to be basically taxed on $40,000 of earned income, because that $10,000 you're deferring to a time when you're going to pay it later. Now, nowadays, they actually have Roth 401ks. And the thing about a Roth 401k is that you can, you're allowed to contribute into it post-tax. And what that means is that basically you can put yourself into a situation where if you make $50,000 and you contribute $10,000 into your Roth 401k or your Roth TSP, thrift savings plan for the federal workers, if you have a $50,000 of earned income and you put away 10, your earned income is still going to stay at 10, right? So you're not getting a tax deduction now. Now, the whole thought of that. The whole thought of putting away money tax deferred into the classical 401k and thrift savings plan is that the belief is that you're going to make less money in retirement, so your taxes are going to be lower. But my question to the audience today is, do you really believe that your taxes are going to be lower in the future in terms of tax rates, right? Mm-hmm. Just remember that 22% bracket today used to be 25. And so if Joe Biden actually, kind of lives up to his campaign promises, he's going to cut the Trump tax cuts. Now, he also said that it's not going to affect anybody that's, making under $400,000. So both of those things can't be true. So we want to see how that actually works itself out. But what we do know for a fact is that we are in a very, very, very efficient window, and you need to take advantage. So here's the thing to think about. If we put money into a Roth plan now, you can pull out not only the principal, but also the earnings tax-free forever. So if you let it grow for the next 20 years, those earnings are all tax-free as well. I think where people are not thinking through, or no one has ever informed them about, is the fact that even if your tax rate may be lower in retirement, which is a questionable, premise to begin with, the reality is there's certain income streams that you'll receive in retirement that aren't necessarily taxable. And that's all dependent on your income, on your taxable income. So Social Security, for example, what we're seeing in our office is couples that have a combined Social Security benefit. If they live to their standard mortality ages of 82 to 85, they're going to receive between $1 million and $1.5 million in Social Security benefit. Now, that Social Security benefit was never meant to be taxed when it was originally created. But believe it or not, Cynthia, Ronald Reagan was the first president to create a taxation on Social Security in 1983. Okay. And Bill Clinton made it more taxable. So up to 85% of Social Security can be taxable. And the important thing to think about is if you've got $500,000 saved for retirement now, but you're going to have $1 million, $1.5 million of benefit from Social Security, and one thing causes the other thing to be taxable. Well, how does that work, right? Yeah. So do you really want to pay tax on Social Security? In some cases, we can't make it tax-free. But in some cases, it depends on whether you have a taxable pension and all of those things. But it really makes sense to create a structure to create the most efficient tax, policy we can, to have this very, very cohesive plan. Sure.
So it all just ties into the plan, Stewart, because obviously everyone's situation is going to be a little bit different that comes in, obviously, to sit with you. But I think a lot of people this year specifically, and probably prior years as well, focusing in on tax is really important.
Yeah, I mean, listen, during tax season is a tough time. Last year was crazy with COVID because it happened kind of right in the heart of tax season, so it really spread out our tax year. But we're going to do between 500 and 800 tax returns this upcoming year, and what we're seeing universally is people are concerned,
yes.
And the whole reason we have the tax office isn't to prepare those taxes, right? It's to really create a solid financial plan that really considers taxes when you make those plans. So, when we have somebody's entire tax model inside our tax software, it's really easy to see if we add $20,000 or $50,000 or $100,000 of Roth conversion. And what we mean by conversion is actually switching your existing IRA or 401k over to Roth. And everybody knows Roth is better. I think people get that. The question is how to do it, how to implement it. And the reality is that it's really tough to get that advice from a lot of advisors because they don't have a tax office built into their practice, People just say we're glutton for punishment by having this tax office. It's so much work because it does take up 2 or 3 months of our time, But the information we get, for our clients is just exponentially better.
Absolutely. And how do you put a price tag on that, right,
Right.
Stewart? I mean, it's invaluable.
That's
This
it.
is the perfect time for us to open up the phone lines. Do you want to tell the viewers what they can expect to receive by calling in today?
Sure. If you just call 833-652-7829, what we'll do for the first 10 callers, we'll offer you a complimentary portfolio review so we can take a look at all of your existing 401ks, IRAs, etc. And what we'll also do is tell you what we think about your tax profile. If you bring in your tax returns as well, we can really give you some neat pointers. We'll have our tax people analyze your tax return and say, hey, this is how we can create some more efficiencies for the future. Just call 833-652-7829. We'd be glad to look at it.
Stewart, thank you so much. To the viewers at home, the phone lines are now open. That number to call once again is 833-652-7829. We know you have a lot of questions on how to retire comfortably and with confidence. Stewart has the answers for you. Again, we have to take a very short commercial break, but when we come back, we're going to have more questions and answers on how to plan your perfect retirement. Please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today, obviously talking about such an important piece of the whole planning process, which is taxes. Wanted to talk a little bit about pensions, if we could, just for a moment, because you mentioned it briefly, and then also affecting Social Security, if you will. So can we talk a little bit about pensions? People still have them, Stewart? Or are they kind of going away?
Well, you know, we have 2 offices in the greater Phoenix area. Currently, we're building a 3rd in Tempe, but we have one in Sun City, one in Scottsdale as well. And, you know, we also have a presence in Michigan, actually. So we have a couple offices outside of Detroit. And what we see between Michigan and Arizona is pretty different. You know, in Arizona, for example, here, we aren't seeing pensions like we used to. They are going the way of the dodo bird. They're going away. But what we do see is some really neat companies locally here, you know, some great companies like Honeywell that have these really neat pensions. But there's so many choices as to when to take them and how to take them and so forth. We've talked about this in previous weeks where, you know, we said, you know, people will ask, and you've asked before, is does it make sense to take the lump sum payout or to take it over time? Well, it all depends. What you want to do is make sure what your options are when it comes to pensions. Just because, you know, remember, pensions are taxable. And remember what we talked about in the first segment, we talked about taxation on Social Security. Well, if you have this irrevocable income stream that continues on, it may make your Social Security taxable all at one time. And so it's really worth taking getting a second opinion, not just listening to your buddies at work at the water cooler that are saying, hey, I did this and you should do this too. Well, you know, just remember, a lot of these people that have tons of money saved inside their 401ks and IRAs and so forth, have done really well because the market has quadrupled over the last, decade. It's done really well. Blind Chicken could have made money in the market over the last decade. Now we're getting into these really volatile times, and when it comes to, time to make these decisions, whether you take your pension up front or you take it over or the lifetime income, you want to make an informed decision because honestly, some of these pensions, even within the same company, like at Honeywell, for example, there's some pensions there that if you take it at 62, you're getting, for example, $2,000 a month. If you take it at 66, you're getting $3,000 a month. But there's some pensions within the same company that don't grow over that period of time. And so when we have clients come in, they're here to talk about their finances. Well, to me, that's important to me. Even if it's something that we don't get paid to do per se, we look at everything. We try not to let any stone be unturned, right? So when it comes to taxes and risk management, we really do try to consider everything. And I think pensions are a tremendous part of retirement.
Absolutely. And again, it comes back to that total holistic plan that you help people actually develop, if you will, because it's so important to enter the retirement years with a plan. Stewart, is it still an astronomical amount of people that do not have a plan going into the retirement years?
Yeah, I think people are winging it. The nice thing is that we've had this really great market, like I said, and people have felt like they're impressive, market makers because they can, buy an S&P 500 fund and it's done that well. Well, just remember, like I said, everyone's done well. Now we're getting into these volatile times and some pretty uncertain times. We don't know what the future holds in terms of policy, how that's going to affect the market. I try not to get pulled too far to the right or the left when it comes to, news because, it's just a lot of kind of quasi propaganda. We don't know where we're going yet. It's all campaign promises, right? So on both sides.
Absolutely.
So, hopefully, you have a plan. And remember, the importance of a plan is to make sure that you can change it. Sometimes we have to call audibles.
Yeah.
Like I was talking about the 2015 Budget Act when Social Security changed. We had to make substantial changes to our plans with tons of our clients that haven't filed yet, right? So you have to be, it's not a set it and forget about it kind of thing. It's an evolving deal.
Absolutely, and I love the fact that you mentioned that it can be changed because obviously life changes. You have different things that happen throughout the stages and you just need to be able to address those. Most importantly, I'd love to talk to you a little bit about the importance of working with a fiduciary such as yourself, Stewart. To the viewers at home that are just watching for the first time, let's explain to them why that is so important.
Right. Well, first of all, dealing with a fiduciary is a minimum requirement. It's not something you hope to achieve. It's something that should be a minimum. And what a fiduciary is somebody that works on behalf of their clients and is paid by their clients. Now, the reality is this. The fiduciary standard we've been living by for about 8 years here, and we're way ahead of the curve before it became, before the pressure was put onto these firms to become fiduciaries, right? Almost everybody says they're a fiduciary now. But what I would ask you is to ask yourself, what are you paying in fees to your advisor? And if your answer is, I just don't know, or I don't have to pay any fees. Well, that's a problem because you have to understand, as much as I love my clients, and I'm telling you, I don't work with people I don't like, right? And you shouldn't either. But the reality is I get paid to do it, right? That's why all of my financial clients, I make my cell phone available so that, I make a great living off of taking care of these people. So if their life savings is with us, and remember, we hold the money generally at TD Ameritrade or Fidelity or Allianz, one of these really great monster companies, they need to know that they can reach us.
Absolutely.
Right? And if somebody's calling me on the weekend, on a Sunday when I'm watching my son's basketball games, well, that's okay, right? I'm only able to do that stuff because of my clients.
Sure.
And it's really important to make sure, that we give back. I mean, in multiple ways.
Absolutely.
And it's important that they can contact us.
Absolutely, and everyone loves that you are so available, Stewart. This is the perfect time for us to go ahead and reopen the phone lines. Would you agree?
Sure.
Okay. To the viewers at home, the phone lines are once again now open. That number to call is 833-652-7829. We know you have a lot of questions about how to retire comfortably. Stewart has the answers for you. He's offering you a complimentary consultation today, a portfolio review. Let him take a look at what you currently have in place. Is it the right plan for you? Does it need to be tweaked or adjusted? Have you had some changes recently? Stewart can make sure that you're in the right place and in the right hands. Again, the number to call is 833-652-7829, and it's complimentary. All you have to do is pick up the phone. We'll be right back after this very short commercial break.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is the co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today. Obviously, we've talked about the importance of planning for taxes, and we tapped in a little bit about the importance of working with the fiduciary. So I have a question for you. I know there's a lot of different financial advisors in the world, stockbrokers. Can you help us understand what is the difference between all of them?
Okay. Well, first of all, like we said at the beginning, a fiduciary basically works for the client. And when it comes to the fee structure, we basically charge a percentage of assets, or a percentage of the assets that are under our management, we charge a fee on. Now, what most brokers do is, if you take a look at your funds in your portfolio, and if you have mutual funds, for example, what you'll see is an A, B, or C after some of those funds. And if you see an A, B, or C, what those are typically loaded funds. They're loaded mutual funds, which means that the advisor or the broker is actually being paid by the mutual fund company and not by you. What you never want is to have in the back of your mind, a concern that maybe that advisor is only selling this fund family because maybe there's a trip waiting for him to go to the Bahamas, or maybe there's a backdoor relationship with the firm. And there were tons of class action lawsuits in the past that dealt with these things. But for us, if we have two identical funds and the only difference being fees and back-end compensation, well, here's an example. If we have a fund that is 0.14% in expenses and the other one is 1.4% in expenses, but that other 1% goes to the advisor, well, here's the thing. It doesn't do us any good at all to use those funds, because by law, we're not allowed to receive any of that compensation as a fiduciary. So stockbrokers, just remember, things have changed. Things have gotten way better in our industry, and I think that people are becoming way more aware of that. Judd, my partner, is actually, he was one of the kind of spearheaders here in Arizona. One of the first, he was way ahead of the curve. 8 years ago, he was one of the first fiduciaries in our kind of circle, and it was great. It's really kind of helped grow our company, but we're not allowed to receive any of that that back end conflicted commission.
Okay. Stewart, I know obviously with the shows being so successful, let me ask you a question. With a lot of the people that are calling in that are gaining the complimentary consultation with you and Judd, are you hearing a common complaint about prior advisors? I mean, is there something that people are saying more than anything else?
Well, yeah, I mean, what we're seeing is just communication, right?
Okay.
There's a lot of people that just don't hear from their advisor. This has been a really crazy year for everybody when it comes to the market. I mean, it's been incredibly volatile. A lot of phenomenal money managers have had a really tough time in the last quarter or two. But I think communication is everything. And the way that we make that easy, and whether you're meeting with Judd or I, one of the partners is first of all, it'll either be he or I. We don't, unlike other firms that, have different marketing tactics, they'll have a spokesperson, but then they pass you off to a junior advisor. That's not at all what we do. You're going to deal with one of the partners, one of the owners of the company when it comes to asset preservation. But the common complaint that we hear is just people, they can't reach their advisor, or, the reason for that is people don't make any change. People don't get up off their couch and make the call. And even if they know, hey, you know what, our guy really isn't doing what he's supposed to do, it's just very difficult for people to make any sort of change. They don't do it.
Sure. And again, like you mentioned earlier, Stewart, it's so important to have communication with your advisor, your financial planner, if you will, because with everything that goes on in life, with all of the changes, you need to know that that person is available. Let's say you lose a spouse, or you have an adult child that needs to move back home, perhaps lost a job. All of these changes can affect your entire plan. Without communication, you wouldn't know where to turn.
No doubt about it. And I think it's really important to communicate. And, the one thing we would say here is that if you aren't getting the communication that you think you deserve, and when I say you think you deserve, you absolutely deserve it, right?
Sure.
Like, some people just don't know what they don't know. They're just used to this kind of neglected relationship. That's not the way it's supposed to be. And it's not the way it is at Asset Preservation. But if you do give us a call at 833-652-7829, or if you go onto our website at www.apsitaxes.com, you can set an appointment with either Judd or myself. And what we will do is take a look at all of those fees. We will give you, white glove service. Just give us a call. We'd be glad to help.
That's what everyone loves so much about you, Stewart and Judd, is they feel like they're getting that personal attention. So thank you for another amazing show this week.
Well, thank you. You've been great.
Oh, thank you, Stewart. To the viewers at home, thank you for spending time with us again this week. That number to call once again is 833-652-7829. You deserve to have the retirement of your dreams. Stewart and Judd can make sure that you get there comfortably and with peace of mind. Thank you again for spending time with us this week. We will see you here again next week. Be safe, be happy, be blessed, and keep the questions coming.